Hey, what's going on, everybody? Welcome back to another episode of the Fortified Life podcast, where we are passionate about developing a dependency on Jesus in the marketplace. I'm your host, Jason Davis, aka Mr. Fortify, and every week we have the opportunity to bring on authors, speakers, coaches, all sorts of professionals that are passionate about putting God back in business. This is one of our special tools and resources episodes where we like to go under the hood a little bit further on things that can help you in your day to day business, work, and life. And I am very excited for our guest today because we're going to talk about the big T word, taxes, with a awesome lady. She will be familiar to a few of you because we did this. We did something like this about a year or two ago, and it was a very well received episode. So, appearing for the second time in all of her wisdom is Janet Kaup, owner of Padgett Business Services. And folks, I got to tell you, one of my absolute favorite people, me and my wife and I, one of our favorite people in this world. Janet, it's great to have you back on the show.
Thank you, Jason. It is so wonderful to be back with you. It's an honor of mine to share some time with you, and I love to support this endeavor of educating families and business owners to make sure that they are seeking wise counsel, and they can certainly find that here with you and with your guests that you bring to the podcast. So, thank you for including me in that ministry.
Absolutely. Well, Janet, I know you're not the biggest fan of heaping praise on yourself, but just for the folks who may not have listened last time, just give them a short, brief intro before we dive all the way into the meat of our discussion.
Sure. I have owned my franchise, Padgett Advisors, formerly known as Padgett Business Services, but we still answer to either name. But Padgett Advisors is there to support business owners and their families in the areas of tax, accounting, advisory services, and as well as full service payroll offerings. I have been the owner of the Padgett here in Gainesville, Georgia. We serve Hall County, Gwinnett County, but anymore the world is so small. As you know, we have clients as far as California and Washington and beyond. So we can serve people wherever they are, so long as they're happy working in a remote environment. But I have owned the practice since 2002, so I have quite a few years of experience. I've seen a lot in small business. I have seen things go really, really well, and I've seen businesses be successful through recessions. I've seen businesses fail during recessions. This passage of time brings a lot of insight, and we feel like we can give our clients a lot of advice and direction. We do specialize in the small business market. So working with families is important to us. It's what we do each and every day. And we do attempt to stay as on top of upcoming changes as possible so that we can educate our clients on what's happening in the world and how it should impact their decision making. And we want to be as proactive as possible with taxes and also with helping our clients achieve their goals.
Absolutely, Janet. I love it, folks. Janet is somebody you definitely want to get to know. So before we close out, we'll have Janet give all of her contact info and where you can find out about her and her how she interacts with clients, and we'll have that in the show notes. Janet, when you talk about providing value to your clients, there's been a couple of main topics that have kind of been at the center of everybody's attention as of late. And so let's start with the FinCEN reporting requirements that went into effect. This, I feel like, Janet, this has kind of taken the business community by storm in many ways. And then you could argue to a certain extent, some people kind of maybe about a year and a half ago, they kind of saw this coming down the pipeline. So where are we at with this? It seems like there are changes probably by the week. concerning this. So just outline that for everyone and just what you are seeing concerning these requirements.
Yeah. So for people like you, Jason, who've kind of been staying on top of this topic, some of these acronyms that we're throwing around are commonplace acronyms. So the
Hmm.
place that I would like to start with our education is really to talk about the common acronyms that you're going to hear in the news or that you have been hearing in the news and boil down really quickly what those stand for so that when we continue to use the acronyms, everybody's on the same page. The first one is FinCEN. FinCEN is the Financial Crimes Enforcement Network. They are a division of the government responsible for anti-money laundering is the thing that comes to mind, but basically any financial crime. They are the policing department of those types of things. So we refer to them as FinCEN, their acronym. Um, the other one that we hear a lot is CTA, which is the Corporate Transparency Act. This is the act that gave birth to the acronym that we hear now most often, BOI, Beneficial Ownership Information. So this Corporate Transparency Act was actually enacted in January of 2021 as part of the Anti-Money Laundering Act. And its purpose was to combat financial crimes like money laundering. And its requirement was for small businesses to disclose their beneficial ownership information to FinCEN. So that's where this whole thing came from. And on the outset, you may say, well, that sounds like a noble thing to be doing, offsetting and preventing money laundering and these other financial crimes. And why didn't we hear about this more frequently until now, if this has been
Hmm.
an act that's been passed since 2021? And the reason is because the compliance deadline was set for the end of this calendar year. And
Hmm.
a lot of organizations were asking for some direction, for some clarity on what does beneficial ownership actually mean. The very loose definition is that it's individuals who own or control a business. The beneficial owners are said to own directly or indirectly 25% or more of a company and exercise substantial control over the company. Well, in the real world, in a small business, when there's a husband and a wife, or let's just say there's two spouses and one of them is self-employed and has a business, the other spouse, though they may not have ownership on paper in writing,
Hmm.
they certainly can sometimes exercise substantial control in that family business. They have access to the funds. They are helping their spouse to pay for things, distribute money, make decisions of a financial nature from that business. So one of the questions is, are they exercising substantial control, and should they be listed as a beneficial owner in that circumstance? So that's where some of the lack of clarity with
Hmm.
beneficial ownership has come into play. And that's one of the things that a lot of groups have been asking FinCEN for more information on, because there are other parts of the law where substantial control and beneficial ownership might have a slightly different definition than what we're seeing come out from FinCEN. The things that are required to be reported are for these owners are their name, their date of birth, their home address, and a unique identifying number, either the number from your passport, your driver's license, or some type of other government issued ID. One of the problems that has arisen from this, the challenges that has arisen from this, is a question about government overreach,
Hmm.
possibly, because this is a federal requirement, and typically the organization of businesses happens where? At the state level,
At the state
right?
level.
So there's a lot of concern that this is an overreach, that asking for this personal, sensitive information to be stored in a government database is it should not be allowed. So those were some of the challenges that came in with FinCEN. And so a lot of people, I don't know, I imagine that you have received an email from the Georgia Secretary of State telling you that you might have some obligation to report under this. Do you remember receiving one of those for your business?
I surely do.
Yeah, we're lucky that we live in the state of Georgia, where our Secretary of State was proactive in trying to help give some direction on this. But there's still a lot of businesses out there, Jason, who don't really interact with their email, or their email address is not the one listed with Secretary of State, who may not have heard of this requirement. And
Mm,
there's an estimate of over 32 million businesses who would be forced
mm,
to comply with this regulation. And getting the word out to all of these entities is no small feat for sure. And educating people on what they need to do. I can't tell you how many clients of ours have called or emailed and said, "I'm getting these solicitation emails in my inbox. Is this legit or not? And what do I need to do?" So in the world where people are capitalizing and advertising services to represent businesses for a fee and help them be compliant with this, it can be very confusing and very, very misleading. But it's a huge issue. Over 32 million businesses on an estimate who would be required to comply with this. So this applies to a lot of folks. And when you think about money laundering and these huge topics, you might think, well, this doesn't apply to my coffee shop or my hair salon or
mm,
my auto repair business, because we're just too small to be faced with anything that has to do with this. And that's actually incorrect. This
mm,
really is a requirement of smaller businesses. The people who are, or the companies who are exempt from this requirement, are large entities with more than 20 full-time employees and $5 million in annual revenue, operating from a physical U.S. location.
mm,
Also, banks, credit unions, insurance companies, publicly traded companies, and any other business that's heavily regulated are exempt. So, if you think about the small business community, this impacts nearly everyone that you meet on the corner, right? Every
yeah.
mom and pop shop out there would be required to comply with this and navigate on their own to figure out who a beneficial owner is, how they interpret this law. Uh, Off the cuff, it seems very straightforward. When you visit the website to enter your information, it takes literally just a few minutes. And we've recommended clients to actually work with an affiliated attorney that we recommend to do these filings for them, simply because we feel like there's going to be more guidance to
Mm,
come in the future, and we don't know exactly what that's going to entail. And if you are like most small business owners, when you check that off the list that you've done it, you're probably never going to think about it again. But the benefit of working with a professional, especially an attorney, to perform these services is that they're going to be staying on top of this as things
mhm,
develop. They're going to be reaching back out to educate you. If you've chosen a company that's reputable, they're going to be reaching back out to let you know of any updates. And the reason that that's important to me is because the penalties for noncompliance are huge. I mean, the penalties for giving false information can be $500 per day. Um, for
jeez.
for an everyday business, that's unbelievable. And
Yeah.
what is false information? If you have a typo in your address and you didn't realize that when you input that information, is that a false reporting? If you move or your driver's license number changes and you fail to go into FinCEN within a very short period of time and let them know of this change, is that then considered false information because you haven't updated it timely? There's a lot of gotchas that
Hmm.
could come out of this. And that's the reason that we have been very hesitant to provide this registration as a service ourselves, but we have aligned ourselves with attorneys that we trust who will do this. The FinCEN database is a question that some people ask about too, like where is this information being stored? And
Hmm.
FinCEN has said that they're going to maintain the beneficial ownership information in a secure, non-public database, accessible only to people who are authorized to have that kind of access. But there's a lot of question about, about the trustworthiness of such a database, and a lot of groups have had an issue with the existence of it, truthfully, and questioning its security. But as the year has come to a close, um, and we're getting closer and closer to the December 31st deadline for this requirement, there have been some court cases that have come up.
Hmm.
December the 3rd, for example, a federal judge in Texas issued a nationwide preliminary injunction, which temporarily halted the enforcement of the BOI reporting requirements, based on concerns for its constitutionality and the potential burden on small businesses. As we said before, business owners are having to figure out, what the language of this act means, and who is a beneficial owner. Um, this went totally viral in the media instantly, as you can imagine, because there are so many groups who were just putting it off, putting it off, putting off, not wanting to go ahead and comply with what the act said. So this was felt like a little victory for some people. And then December 23rd, the day before Christmas Eve, the Fifth Circuit Court of Appeals lifted the injunction, and that meant that the enforcement could proceed. And in response to that, FinCEN extended the reporting requirement to January 13th to provide additional time for compliance. So nice round date that everyone can remember, January 13th instead of December 31. But then just 3 days ago, the Fifth Circuit vacated its earlier stay, reinstating the nationwide injunction, and
Hmm.
basically put a true pause on all BOI reporting requirements. And there's going to be a time in March 25th, where there's going to be a time to hear arguments in New Orleans. So it's not possible to enforce this regulation until those arguments have been heard and hopefully final decision has been made. So
Hmm.
that's the timeline and the history. If your eyes aren't glazed over by now, good for you for sticking through that. But as of right this minute, there is nothing that you have to do. If you have already gone on to the FinCEN website and registered all of your beneficial ownership information, of course, you're just ahead of the game, and there's nothing further that you need to do. But if you haven't registered your beneficial ownership information as of yet, the only thing you need to do is stay tuned to find out what happens in March. I don't believe that this requirement is going to go away. But I do believe that we'll have some more clarity on some of the questions that the AICPA and others have been asking about, some definitions, to make sure that people are very clear on what needs to happen, and very clear on some of those potential problems that could come up if your name changes, if your address changes, if any of that beneficial ownership information changes. We need to know what the window of time is for making corrections to those things. So that's what I feel like is going to happen in the future. But again, this has been the boomerang these
Hmm.
last few weeks of the year, waiting to see, do we do it? Do we not do it? So time will tell.
Very, very informative, Janet. And I would imagine that over the next 90 days or so, we may continue to see in the media, at least, and in the small business community, just, continued chatter, but at least the date is out there. So the March date, you said March the 25th?
Yes.
Okay. So folks, if you're listening, we'll have links and everything, not just for Janet, but we'll have links to the FinCEN website, and obviously seek the counsel of your tax and legal professionals concerning this for sure. We'll have links to that. But uh, Janet, just thank you for that breakdown because it just seemed like it was kind of like a tidal wave starts, Janet. It starts off really,
Yes.
really small and then it gets larger and larger and larger. And then it gets to where it's hard to contain. And then if you hadn't been informed or whatnot, it can kind of feel like the weight of it is crashing down. And just after between the media and not that there's fear mongering, but there were very serious. You mentioned the fines of
Yes.
$500 per day. I mean, that could absolutely take out a small business, depending on your cash flow. So the seriousness of it was something that a lot of people tuned in on for
Yes.
sure. Well, folks, as Janet mentioned, think, in my opinion, at least, Janet, I don't think it was a glaze over. It was something that it's like, hey, you need to look at this so that it isn't looking at you.
That's a great way to put it, Jason.
Yeah, look at it so it doesn't look at you. So, Janet, we're going to, and I love this because, folks, this is very collaborative. The last time Janet and I got together, I said, well, yeah, Janet, what are some questions to do this? And folks, I got to tell you, when it's someone's passion because she said, "Oh, Jason, we could talk about this, and we could do that, and we could do this." And I get excited about financial things, but specifically tax. Janet is very passionate, and she said, "Now, wait a minute, Jason, coming into this episode, there's so many things to talk about. Let's try to narrow the convo." And so we're going to pivot from fence and wonderful breakdown, Janet, and we're going to go to the next thing, which is probably besides Fenton, the next and second most talked about thing, especially with a transition, a new presidential administration coming, and that is the implications of the 2017 TCGA provisions. When they're expiring. And so Janet will give a breakdown on those and what 2025 may mean to you as a small business owner, as a family. So Janet, kind of give the outline of where are we? I know we're kind of dusting off, just kind of like fencing. It's like, oh, I hadn't thought about TCGA since 2017, and here we are in 2024, and just like with fencing, it's like, wait a minute, there was an expiration. Wait a minute. What does that mean? Wait, what will I have access to? And here comes the anxiety
Right.
again. So, Janet, tell us about where we are with TCGA.
So for the Tax Cuts and Jobs Act of 2018, most of those, a lot of those provisions were set to sunset. And sunset just simply means that they expire. These were not meant to be permanent. They were meant to be temporary. And the expiration date is December 31st, 2025. So though you may not see a huge difference in your 2024 tax filing that you'll be preparing in the next several months, you do need to have a conversation with your tax professional and just be aware of what's coming if these provisions do expire. Obviously, this was the enacted under the Trump administration, so there's some feeling that because he is going to be acting as president again in the new year, this bill was near and dear to his heart, and we anticipate that a lot of the provisions, there's going to be discussion about making a lot of them permanent, but we don't know yet which ones will be made permanent and which ones will be allowed to sunset, and that's going to be something that we feel like the 2025 year is going to bring a lot of discussion and legislation. As many of you know, we have a federal deficit to deal with, and these tax provisions, they cost money. Because the federal government, in order to pass a tax reduction, has to get that money from somewhere else, which means that when one thing, when one tax goes down or when a credit here is increased, that money's got to come from somewhere else in order for the federal government to pay its bills. Um, just like in your own home budget or in your own business budget, you can't spend money in one place without taking it from someplace else.
Hmm.
And so we don't know which ones of these provisions are going to be popular enough, truly. I think that is going to determine a lot of what stays and what goes is the popularity. But some of these things that you may have gotten used to the last several years while filing your taxes, and for younger business owners and younger individuals, younger taxpayers, you may only have started filing taxes since 2018. So this may be all you know. But I'll give you a rundown of some of the provisions that are set to expire at the end of 2025, unless they're made permanent. We'll begin talking about individuals, and then I'll give you a few that specifically relate to businesses. Part of the Tax Cuts and Jobs Act included lowering the individual tax brackets. The brackets are incremental, meaning that as you earn income, you fill up the first bucket, and then the next dollar that you earn is taxed at the next rate. So there's not a cliff where you could say, if I earn one more dollar, then all of my income is going to be taxed at a higher bracket. That's not how the tax brackets work. And we could probably spend some time on another podcast talking about just that topic. But for the sake of our discussion today, we should be aware that the tax brackets as we know them today, and that's the 10%, 12, 22, 24, 32, and 35 and 37% brackets will go back to their pre-2018 rates and brackets. So what happened was the tax rates were lowered and the brackets were expanded. So more of your money was taxed at a lower rate after Tax Cuts and Jobs Act, which ended up being a tax savings for many, many Americans. The other thing that happened was the increase in the standard deduction. It nearly doubled. So the standard deduction for single people is $6,500, $13,000 for married filing jointly in 2017. That'll be adjusted for inflation. The new standard deduction is basically doubled those amounts. And with that, the Tax Cuts and Jobs Act eliminated what's called a personal exemption. So there was a separate line on your tax return in 2017, which gave you a deduction based on the number of people in your tax household. That line totally went away. And in exchange, we also got this new increased standard deduction so that people didn't have to keep up with their mortgage interest and charitable giving and state and local taxes. Those were some of the more popular, itemized deductions. So you get to deduct from your income either the standard deduction that the IRS allows, or you can itemize your deductions. And this was a method of simplification because it increased that standard deduction to a point where many people who previously itemized no longer had to because the standard deduction was so much higher than their itemized deductions would have been. So that may change at the end of 2025, and it may become necessary then for you during 2025 to keep up with those things that you haven't had to keep up with before. Like medical expenses, for example. Certainly your state and local taxes, real estate taxes included in that, your mortgage interest, and all of your charitable giving. So if you've been kind of leisurely about dropping things off at Goodwill and not picking up the receipt, not keeping a list of what those things are because it hasn't mattered on your tax returns in the last several years, you may want to be mindful of that in 2025, that when those provisions expire, then you may be itemizing again if you previously did before 2017. The child tax credits also changed. They increased to $2,000 per child, $1,400 of that being a refundable credit. That's going to go back to $1,000 per child and is non-refundable unless something happens in Congress to make that change permanent. Then there was a new credit that was introduced for other dependents who were non-child dependents. That was $500 per
Mm.
dependent. So this could be if a parent is a dependent of yours and you're providing over half of their support, you would qualify potentially for this non-refundable $500 credit under the current law. That did not exist in 2017. So that would be an item that is set to expire. And then another acronym. We talked about acronyms earlier today. Here's another one to talk about: the SALT deduction limitation. And SALT stands for state and local tax.
Mm.
There in the Tax Cuts and Jobs Act, there was a $10,000 cap on those types of itemized deductions, which meant that if you paid more than $10,000 in your state income taxes, your real estate taxes, any ad valorem taxes, sales tax for those people who live in states where your sales tax may be higher than your income tax, perhaps because you don't have income tax in your state. All of those deductions, the state and local tax deduction, the last several years that's been capped at $10,000, and that will expire, allowing taxpayers to fully deduct their state and local taxes paid again, so long as they're itemizing. There was also a reduced mortgage interest deduction for debts up to $750,000 on your residence, essentially. That will revert back to $1 million. So if you have a larger mortgage, you won't be limited on your mortgage interest deduction if this particular piece is not extended. Um, there was also a suspension of miscellaneous itemized deductions. Um, for the last several years, for example, if you were a hobbyist and you had a hobby that involved some expense on your part, you had income coming in, perhaps you did some sales of something that you created on the side in addition to your full-time job. Well, that income was still taxable through the Tax Cuts and Jobs Act. But as a result of the Tax Cuts and Jobs Act, you could no longer deduct any of your hobby expenses, which really has been difficult for a lot of people who do have hobbies. You had to really question whether it was a hobby or whether it was a business, and if it was a hobby with hefty expenses, it might be cost prohibitive to actually engage in that activity because your expenses couldn't be deducted. So we've had a lot of hobby versus business conversations since Tax Cuts and Jobs Act. Um, if this provision expires, then you will go back to being able to offset your hobby expenses up to the amount of your hobby income. So if that's something that impacts you, you'll want to keep an eye out for that. There are other miscellaneous itemized deductions too, like unreimbursed employee expenses. Since
Mm.
Tax Cuts and Jobs Act, if you were a person who was involved in sales, for example, and you incurred a lot of cost traveling to your customers that your employer did not reimburse you for, or perhaps you would entertain and take out clients or potential clients out to dinner to try to secure business with them, or you would buy your own computer equipment or those kinds of things in your job that was used for your job and made your job easier, but your employer never reimbursed you for those. There was a provision in the taxes before 2018 that you could take a deduction for those unreimbursed expenses. This also included things like union dues, professional education, those types of things. If you were an itemizer and you had at least 2% of your income in these unreimbursed employee expenses, the amounts over 2% could be deducted. And Tax Cuts and Jobs Act simplified the code, took all of those deductions away. So if that sunsets, you'll be allowed to take those deductions again.
Mm.
Um, One other big thing that we want to keep our eye on is that the estate and gift tax exemption. which was approximately 12.9 million per person in 2023, will revert back to the 2017 levels, which is approximately 5.49 million adjusted for inflation. So we haven't heard a lot of everyday people doing estate tax planning like we
Mm-hmm.
did pre-Tax Cuts and Jobs Act because 12 million's a long shot for a lot of people.
Mm-hmm.
But 5 million, even adjusted for inflation, may not be such a long shot, which means that your estate could be subject to tax, which directly impacts the amount of money that you're able to leave to your heirs. So this is an area that I feel like we're going to see a lot of discussion because it's been we've gotten used to these high levels of exemption for estate. We haven't seen estate taxes typically in our common practice. Um, so that's going to be an area I feel like we're going to see a lot. And then a lot of people may not have ever heard of the word or the acronym AMT, Alternative Minimum Tax. So you might not know that there's a tax provision there that if you don't pay enough tax in one set of rules, they can get you to pay tax under another set of rules. These adjustments to the AMT included some higher exemption amounts, so fewer and fewer people actually were subjected to the alternative minimum tax rules under Tax Cuts and Jobs Act. So that's going to sunset if it's not extended or made permanent. And then one of the other things that families have enjoyed under the Tax Cuts and Jobs Act has been an expanded education savings account, the 529
Mm-hmm.
plan. Jason, you may have friends that have done this with their college, typically college savings, a 529
Mm-hmm.
plan under Tax Cuts and Jobs Act. You could use this as a parent or grandparent for K through 12 expenses. So if you had a child that you wanted to send to a private school, you could use their college savings funds and send them to receive K through 12 education, and that's going to be one of these expiring provisions. So those are the top things I feel like most people have gotten used to
Mm-hmm.
as families, but there are some things that will expire for businesses if not made permanent as well. One of the bigger ones is the pass-through deduction, a
Mm-hmm.
Section 199A qualified business income deduction. You may have heard the acronym QBI. What that is for a business with flow through income that flows through to the individual partner or shareholder. Those pass through entities, if you owned one of these pass through entities, then you would receive a 20% deduction on your taxes before tax was calculated on that income. So that's a huge savings for profitable small businesses who are operating as partnerships, S corporations, and that deduction is set to be an expiring provision. And then bonus depreciation is also on the table because it's not a 2025 sunset provision, but the 100% bonus depreciation for qualified property was on its own schedule for phasing out. So it dropped to 80% in 2023. For 2024, bonus depreciation will be 60%. 40% in 2025 and 20% in 2026 before it expires. And this bonus depreciation is not the same as Section 179 depreciation. It's a separate type of depreciation altogether that gave business owners a motivation for investing in assets in their business, buying the equipment that they needed because they could write off as a deduction 100% of that through bonus
Mm-hmm.
depreciation. A few other little things to keep in mind. If you do itemize in the future, the 7.5% of adjusted gross income threshold for medical expenses to become deductible will go back to 10%. So the Tax
Mm-hmm.
Cuts and Jobs Act if you were an itemizer, made the medical expense threshold that you would have to cross in order to get that deduction lower. So you would have to have medical expenses in the future greater than 10% of your total family income in order for any of those subsequent medical expenses to be considered part of your itemized deductions. Um, and then the other item has to do with alimony. Alimony paid under agreements executed after the Tax Cuts and Jobs Act in 2018 is not deductible currently. It's also not
Mm,
taxable to the person receiving it. This change is permanent. So that was part
okay.
of the Tax Cuts and Jobs Act, but that's not going away. So that's a pretty long list. It's not intended to be exhaustive. It was basically a list of things that I felt like impacted the majority of our small businesses and families in the most direct way.
And Janet, that was so informative. I told you this last time, Janet, that my goodness, it's like a master class, and that's just a very small portion of all things taxes. We could probably spend an entire couple of years just going, okay, Janet, let's talk about this thing now.
Yes, we could
And
for
folks,
sure.
more than likely, if Janet, she's about to enter the busy season, so I have to catch her in the off season. Sports analogy. There, I'll have to catch her when if she's not, Jason, I need to just go on vacation for like 6 months. So if she's not vacationing in the Caymans or something like that, then maybe we can have Janet on again when she's calmed back down and relaxed from the height of the tax season, and we could step through another tax
Absolutely.
concept. But Janet, thank you so much for that breakdown on FinCEN and TCGA. As we get ready to close, Janet, I know I asked you something similar last time, but when we think about the tax code, just overall, where do you high level just see things trending? We've got a lot of things on the table. You've got the fence-in thing kind of just floating, and there's that conversation of federal versus state and overreach, and then we've got a transition of a new administration coming in. We've got TCGA, and that doesn't even count conversations of future things to come that Congress and others are considering. So, just high level, what do you kind of see for 2025 in terms of the tax code?
Well, I do see a lot of the provisions of the Tax Cuts and Jobs Act being so popular that I feel like it would be surprising for them to actually sunset. One of
Hmm.
those is the SALT tax deduction limitation. We have a lot
Hmm.
of people in the country who live in very high tax states, and they've been hurt by this deduction, by not being allowed to take a deduction for the full value of their state and local taxes. And so I feel like a lot of states have stepped in and passed pass through entity election abilities for businesses to pay the income tax based on the business profit rather than letting that flow through to the business owner. So that helped to create some deductions where deductions had gone away. But there are other states that don't have that ability, or that's still not enough.
Hmm.
Especially if you're not a business owner, and simply your property taxes and local income taxes and state income taxes as an individual are not are well over the $10,000 cap. I feel like that's going to be an area that's going to be revisited. And I also feel like these pass-through deductions, when Tax Cuts and Jobs Act passed, one of the cornerstone features of that was the 21% tax rate on C corporation profits.
Mm.
And when that was announced, the immediate thought was, oh my goodness, everybody's going to just become a C corporation. Well, to get a lower tax rate. But the qualified business income deduction that we discussed earlier, that was a great measure to curb that mass movement to a C corporation by all of your partnership and S corp clients, because you do get a 20% deduction at the personal level for your flow through profit. And I feel like unless that qualified business income deduction is somehow preserved, um, that we might see partnerships and S corporations having to consider electing to be taxed as a C corporation, or changes in their ownership structure to get that permanent 21% tax rate that the C corporations enjoy. So I think the qualified business income deduction and I think the SALT cap are probably two that come to mind as a business advisor, especially that I feel like will hopefully be revisited. In addition to those estate limits, there's a long way between 5 million and 12 million for American
Mhm.
families, and I feel like there's got to be some more pleasant middle ground, so that people who have acquired land over the years and they've built up, a portfolio. It may not necessarily be cash in the bank. It might be other assets that they've built or accumulated or that have appreciated in value, so that that their heirs won't be punished upon their
Mhm.
death by those reduced estate tax limits. So those are some of the things that I hope for. When you talk about trends in tax, just like with this beneficial ownership, you don't know how the outcome is going to play out until it's played out.
Mhm.
So it's difficult to predict without a crystal ball. But those are some of the things that I feel like we'll definitely see happening, and a lot of it is going to have to do with the popularity of each item.
Mhm.
I know that there's some provisions that definitely impact middle class families and small businesses that will be a focus of the Trump administration. Probably some more of those child tax credit extensions or a modification to what's there. It might not be as high as it is now, but it
Mhm.
might be higher than it was in 2017. So we have to wait and see on some of these things.
Well stated, Janet. And folks, this is why, as we get ready to end here, I feel like Janet, as I shout you out and as we close, I mean, there's so much fear mongering out there, especially when it comes to business and folks staying informed, having a tax professional that you can seek counsel from, like Janet. I would say, man, there's been with Janet, when I think like tax pro, attorney, financial advisor. I mean, you almost need a home. I call it a home team
I call
that
it a
you can,
tribe. You need your
yes,
tribe. Yes.
yes, that you can run these things through so you can make wise financial and life decisions. So, folks, I hope that you found this conversation informative. I believe this answered a lot of questions and gave a lot of clarity for people, Janet. So thank you so much for taking time out of your schedule. I know this is the quiet to before the storm. it's and
Yeah,
so you'll go back into hibernation for a little bit,
right.
and then come back out. Like I said, we may have to bring her back after she's done vacationing, folks. But Janet, before we go, what's the best way for people to reach out and connect with your services and find out how you are serving clients?
They can contact us through the contact page on our website or through any of our social media platforms, Instagram and Facebook. I'll provide those links to you as well. They can also phone the office. We're a pretty traditional business. We like to have conversations. We're open for appointments Monday through Thursday here in Gainesville. We can also set up a Teams meeting online, or you can phone the office and set up a discovery call. Our phone number is 770-287-1040. Again, Monday through Thursday. So we look forward to connecting in whatever way makes sense for you, whether that's by phone, email, online meeting, whatever your preference is.
Love it, folks. You heard directly from Janet. You know how to reach out to her. And then also, slid it in there, Janet. I see the Microsoft shout out over Zoom there. So I'm just giving you a hard time. But love teams, love teams. But folks, this has been a tools and resources episode. We'll have Janet's information as well as some of the other details we talked about, such as the FinCEN website, and also just different links where you can stay better informed. But this has been a tools and resources episode of the Fortified Life podcast. And in these, we dive a little deeper for things that really affect you day to day, just as the name says, tools and resources so that you can thrive in your everyday life and business. Shout out to Janet Kaup, my God, one of the best people that I know. But folks, you know how we leave things. Don't compartmentalize your faith in the marketplace. And remember, from the boardroom to the bathroom, God is with you. We'll see you next time on the Fortified Life podcast.